in Singapore, private home prices rose again in the second quarter. On quarter, prices rose about 1%. That is a little higher than a flash estimate. Rents are also up 0.3%, but that's a slowdown from the 0.8% gain in the previous 3 months. Last month, Singapore's central bank tightened mortgage rules in an attempt to cool the market and shield buyers from a rise in interest rates. And here to help us digest all the economic news is Leon Perera, CEO of Spire Research and Consulting. Now, Leon, let's start with Singapore. Its home prices. The risk of an interest rate rise, how real is that and how soon can it happen?
Well, the risk is not entirely negligible, but at the moment, we in Spire think it's contained. Singapore, of course, does not control the interest rates. It controls the exchange rates and lets interest rates float. And that would leave Singapore a bit more exposed to an increase in US interest rates should the Fed tapering really take off steam, more so than in other countries. However, I think from a banking stability point of view, capital adequacy ratios are good and there should not be too much concern on that front.
Right, but for home buyers, just so we're clear, that Singapore interest rates could rise before US Fed actually raises its own benchmark interest rates.
Well, no, it would rise in step with that, or it could be affected by that if US interest rates actually increase.
And you're talking about with tapering that
absolutely.
Treasury yields could rise and that could have an impact. It does not have to wait until the US central bank actually raises its own benchmark rates.
Well, it would be something that could happen in line with the tapering, and I think the exposure that Singapore has to that is more than perhaps in other countries where the interest rate is controlled and Singapore the exchange rate is controlled. But having said that, we don't see an inordinate amount of risk at this point to either the banking sector or the broader economy, but we will have to monitor how this develops.
Okay. The Singapore economy has been fairly slow in recent quarters. So there's the internal factor and external factor. With a higher interest rate environment, is that another obstacle?
Well, that could have some impact, but I think the major headwinds facing the Singapore economy would be some weakness in the manufacturing sector and in non-tourism services, which are both seeing a certain degree of weakness, particularly in manufacturing. We don't see a really sustained takeoff and pickup on the manufacturing front as yet. The things that are boosting the economy, construction to some extent, a lot of government construction projects, and also tourism that is doing quite well. On balance, I think we expect GDP growth to come in at about 2% this year, so that is relatively low compared to previous years.
Okay. Globally, it seems that people are arriving at a conclusion that the U.S. economy is the best in the pack, followed by Japan and China and some of the emerging markets that have fallen off the radar. Is that the correct reading on where we are now?
Well, the U.S. economy is certainly on the mend, so I think we are in the mode of growth actually recovering. So there have been positive movements on the housing front in the U.S., and I think those are real and that those will be sustained even though these numbers go up and down. And the quarter-on-quarter growth rate in U.S. GDP is actually higher than the year-on-year growth rate, which is always a good sign for an upward trend. I think we're not into explosive growth or a takeoff rate of growth because unemployment is still stuck at 7.6%, but U.S. is on the mend and we're very bullish about Japan as well.
Okay, great. Thank you so much, Leon. That was Leon Perera of Spire Research and Consulting.